Hi everyone, welcome to another of our Artemis Live interviews, and today I'm delighted to be joined by Luca Albertini, CEO of specialist ILS investment manager Leadenhall Capital Partners, and also Jillian Williams, CEO of Leadenhall. Welcome both of you, nice to see you.
Thank you for your invite.
Okay, yes, thank you.
Luca, roughly a year ago now, in an interview where we discussed the initial impacts of the pandemic and his thoughts on what that would mean. Now we're quite a few months forwards from there, and obviously hoping we're coming out the other side. And so today we're going to catch up on the market conditions that Leadenhall has been seeing, and also explore some of the recent news that came out of your company that a number of your ILS funds have achieved an ESG classification under a specific EU guidance. So to begin, I thought perhaps you could give us a bit of an overview of the year so far for Leadenhall. So turning to you first, Luca, how have market conditions been for you across the cat bond market, reinsurance, and also life, which is obviously a big part of your business?
Yes, thank you, Steve. I would say, generally speaking, we were already in a phase with the firming up of terms. The firming up of terms was underpinned by conversation about the loss history capital that was leaving the sector, and the resetting of the view of risk in the market. So COVID came as an overlay over and above those conversations, and clearly whilst creating a lot of uncertainty and creating losses in a number of areas, on the other side, it has put the spotlight on some remaining weaknesses on terms and conditions. Every time we couldn't tell, or we were having an argument with the brokers or the protection buyers about whether COVID was covered. The wording was going to be analyzed. There has been some court cases, pretty heated court cases on what some of the wording means, not involving us, but these were actually sponsored by the regulator in the UK. And what that meant is that there was an opportunity not only to continue on the firming up of the rates as we have been then reporting in January, and we can continue to report, I would say, in April for the April renewal, but also taking this opportunity to look at what we could call silent COVID, so COVID that no one expected to be covered. Even the buyers sometimes, I would say, were not expected to be covered, but we're helped by the lawyers to make the case for it. But also other things. We had for some time concentrated on cyber, but this was an opportunity to nail more of the cyber conversation, to say, look, we don't want any of the uncertainty that we had with COVID. Now, are we now in perfect land? As you know, insurance is a series of testing of modeling assumptions and legal wording, but clearly the higher awareness from that led to firmer wording on the non-life side. On the life side, we had general beneficial impact on pricing on the basis that cost of capital has gone up with the market turbulence at the beginning of last year, starting from March. We had historically not many players buying protection on pandemic. There were the usual suspect, repeating the transactions, but pandemic sort of decline in terms of things people wanted to get cover on. And then there is a phase where we're saying a lot of people were interested in buying cover for COVID-19, but that's not very, it's difficult to do in the context of an ongoing pandemic with uncertain developments. So I'm not sure much has been transacted, at least with the capital markets. But clearly the next level of attention is we believe that there will be a higher interest in pandemic cover and life cover in general and so something that can be structured to meet this additional appetite is something clearly we're working on, and I think the industry is working on. So generally, also on the life side, we were left with higher overall pricing and the potential for rekindling the interest on a sector like pandemic, which for capital markets players was in slow decline.
Mm-hmm. So quite positive outlook on both sides of your business then right now. So perhaps Jillian, we could turn to you, and Luca mentioned April. Obviously that's the key reinsurance renewals for Japan in particular. How do you feel that's shaping up, and what are your hopes also for beyond that, the mid-year?
The 1/4s have been positive, and the Japanese renewals have again shown a positive discussion on rate, and again a good interaction between the clients, brokers on structures and what they need that works for them, as well as what is we're able to do in the market. Onto the June renewals, which, for 1/6, Yuri has definitely focused our thoughts again on secondary perils and surges like demand surge, as that has definitely, we've seen cases there. But again, this will lead to a little bit of uncertainty on timings. So, it did look like that we were getting data and looking at it and being able to have clear discussions. But with Yuri happening in February, that's again left us with a little bit more uncertainty on the timings. But again, there's really positive talks on against coverages, like Luca was saying, defining and making sure we both know as a market and the client knows clear coverages, and the structures, and also our aggregations and the client's aggregation. So both with those discussions are ongoing and are very positive at the moment with brokers and clients.
Mm. And do you have a feeling how Florida in particular might go? Because obviously that's still the key really for a lot of the ILS markets.
Again, there's ongoing discussions. There's still ongoing discussions about Irma. And again, even though September was when the finalisation of putting in a new claim, it is trying to understand the clients how much of the IBM ER has been put on earlier than that, and now what they're going to do in the future with that. So that's sort of a little wait and see, and they're the discussions that we're sort of trying to discuss with brokers and clients.
Yeah, I guess that might explain some of the cedents coming to market with some early cat bonds covering Florida as well.
Correct.
Good to get out early with something that has some certainty around the terms. Luca, Jillian mentioned the sort of the largest event of the current quarter, the winter storms and the freezing weather in Texas, which is proving particularly challenging for some people, it seems. Are you anticipating that's going to be a difficult loss development, given some of the complexity around it?
Well, definitely. There is no long-standing history of deep freeze in Texas, and so that makes some of the assumptions being made not validated by history. Sorry, Jillian, can you put mute? There is echo. Yeah. So there is an issue with backing on history. The one thing about Texas though is the market is dominated by large nationwide players, and the key ones have released some loss estimate. We expect we tend to see these market players as reasonably accurate, at least that they really try hard to be accurate, and so and if anything a bit conservative in certain cases, and so that is starting to provide to us data to be able to frame the loss. Clearly, some of the early numbers, at least for property cat, are not there. The 18-20 billion is not what we are seeing from the actual loss being reported. But okay, I'm focusing just on property cat here. So we're now looking at something between 10, 12, potentially up to 15. But assuming no material creep from the large nationwide players, which again is more the exception than the rule. 10 to 12 is probably where we're going to land. It is a small, medium-sized hurricane. It does enter into the insurance programs of some of those large players, but I think it would be one of those that will be easier from a ILS fund perspective to manage in terms of reserving and ensuring that is properly covered for existing and new investors.
I suppose it always helps when it's the very largest insurers that are coming out early, because that does give you a good view of things. I suppose it may be a little more difficult for the people who perhaps have quota shares with the smaller regional insurers. That could be a more challenging loss development process, perhaps.
There is a reason why Leadenhall never does quota shares, and it's not something we have ever done in any of the funds. Traditional quota shares, yeah, I think I'm glad I didn't.
Yes, I'm hearing some interesting things about some of the newer companies in the reinsurance market as well regarding quota shares and this event in particular. Jillian, moving over to you, do you feel that this winter storm event could heighten investors' questions again on climate-related issues, being something that's outside of the normal modelling for this loss or type of loss?
Any event, as it should, generates quite a few, questions from investors, and this is again a great way to interact and discuss with investors how our products work and interact with things like climate change. Our discussions lead us to discuss, the weather events and see how climate change can interact with many other variables like the polar vortex. So that broadens our understanding, and working with many different scientists and intermediaries, and helps us provide more details on the frequency and severity of these events. And hopefully passing that knowledge on to our investors.
Yeah, and it seems obviously investors have had a lot of data points to absorb in the last few years, but this one seems like another important one, really, because it displays the sort of scale of events that can actually happen and the fact that they can be outside of modelled experience. And also, I suppose it shows that the unprecedented continues to happen, and that's maybe what raises investor questions. But also, moving on to the other topic we were going to discuss, I suppose this is what is also heightening investor interest in ILS around ESG as well. And you've recently had some of your funds classified under an EU framework for sustainable investment. So Luca, I know Leadenhall embraced ESG quite a long time ago. You've formalized it within the business and had specific activities on it for a number of years now. But how important was it to you to actually get funds specifically recognized?
Well, that is, ESG up to now has a lot of principles out there and a few rules. And when you actually look at principles from a wide range of bodies and areas, you find some quite dispersed range of approaches. And so what we've been trying to do with our team is to say, okay, what are the core objectives? Forget about what other people tell you should do. But why do we believe that ESG is not only good for the planet, but is also good for the underwriting results of our funds, right? And clearly, you would assume that pollution and environmental damage is not good if you underwrite non-life, and also population lives in polluted, environmentally damaged areas are subject to higher mortality and morbidity, so it's just bad across the sector. The poor social conditions again are socially disadvantaged populations are more subjected to die or to have diseases or spread diseases, and they are not building their houses to the highest insurance standards, right? But in governance, it's clear that we've seen it in the past how companies with material governance failures could actually then show that in poor reserving, poor claim management, poor underwriting, right? So, these are principles which for us has always been, totally aligned. These EU regulations, quite frankly, they've been discussed for a while, and they actually published the detail early February for inception the 10th of March. And you may imagine that all those regulations and legislations do not have ILS in mind. They're thinking of primarily of equity and fixed income holders, right? But the importance to go back to your question is it is the first case where actually there is some concrete data and benchmark and threshold you need to set to start complying with the rules rather than just principles. And for us, it's a matter of setting what that means for ILS within the European system, and then potentially through dialogue with the regulator also see how we can influence the view that an ILS manager should have.
So perhaps you'd like to see in future the sort of regulations actually having some relevant element to the ILS market as well, or at least to insurance.
I would like that, but I don't expect it. I think it's more likely, as you say, to insurance. And there is already an initiative in the UK, so it's distinct from the EU one after Brexit, but and Lloyd's is actually looking into that. That's why we say we're looking at trying to pick the best of all regulations that we see out there, right, and adapt them to the ILS business environment.
Interesting. So moving over to Jillian, you've led a lot of the ESG activities at Leadenhall, I know. Can you talk us through sort of an overview of the process you had to go through to get the classification for these funds, and also perhaps explain what some of the challenges might be around that?
There's definitely been some challenges, and I'll summarise two of them. I'm sorry, Luca, I'm going to use that saying that I've used so many times, which is square peg into a round hole. But there's also been a challenge on the consistency of data and interpretation of data, as Luca was sort of talking about. So in terms of the process, it has been more of an adaptive rather than creating totally new new steps or things like that. And that's because I think ILS is a unique small part of the investment world, and the measurements, calculations and methodologies are already quite different. And trying to align measurements and calculations have meant a busy month for Luca and myself and the team. So, but saying all of that, with challenges, there's always opportunities. And I think this is leading us to work with investors, intermediaries and clients and sponsors to work on these measurements and data. And again, bring these discussions to the forefront of what it works well for us. And, I do believe that ILS is quite well centered in multiple areas so that we can build on those discussions and within each sector.
Can I ask what's the feedback been like from investors so far?
Investors probably have been talking about it already for a year, heavily, and have been before. But again, in the last year, we have seen a lot of questionnaires and talking with investors. And again, we've had positive feedback from investors that, again, looking at similar data, but also being able to broaden that out.
Interesting.
Yes, also I would say, if I may add, the investment consultants, some of them are more focused on ESG than others, but clearly some investment consultants do expect funds to be able to put substance to their ESG statements.
Yeah. I've spoken to a few fairly large allocators who are very focused on ESG, and at the moment they find ILS a little challenging because it's a relatively small market for the size of allocations some of these investors are looking to make. But do you think that ESG is going to eventually become a driver for ILS market growth, or could it be if the industry reacts properly to it?
Oh, definitely. I think, first of all, as I say before, we need to be ESG compliant, because that will have a positive impact on our underwriting results, right? So you should do it regardless. But as investors will have to find black and white and gray investments from an ESG standpoint, making ours white rather than gray is going to be very, very instrumental to assets growth. Or even I would say assets growth and assets preservation. So if an investor intends to make sure that all of his investments are ESG compliant, and then he finds out that some of his current investments are not, he may want to move them from that investment to the ESG compliance. So there is the alignment is total, right? Is on the principles, is on the writing result, is on the asset growth.
And underlying all of that, it's on your own business processes within Leadenhall as a fund manager as well, which I think that's the really important thing for investors, is to know that it's been embraced wholeheartedly in companies. Jillian, there's one area that keeps coming up in my discussions about ESG is the challenge of looking through to actually know what's within underwritten portfolios, which obviously spans the entire insurance and reinsurance industry and isn't just relevant to ILS. But what do you think needs to happen going forward to help make ILS even more ESG ready?
I think ILS is a unique product, and again, as I was saying, that one of the benefits is that it intersects many sectors, and so it's working with different sectors and being able to learn from each of those to solve this ESG problem. It's not going to be one that solves it or is able to measure it in the same way. So it is these interactions and broad knowledge, specialty, especially in the physical risk for climate change, that will help the sector and get us further into working with our investors and, from a global point of view, looking at the environment and climate change side. I believe the benefits is where our relationships with the insurance and reinsurance sectors give us knowledge in the physical risk measurements, which can help other parts of banking and the financial sector. And the opposite is true as well in learning and working on transitional risk with the other financial sectors, as they see that as one of their key measurements, and have done for a long time. And it will help us better understand transitional risk, especially within the insurance and reinsurance industry. So it's sort of as I was saying, we're in a great place to work with both of those to look at both physical risk and transitional risk in investment world, as well as the insurance and reinsurance world.
Yeah, and it's interesting how that could potentially result in new product opportunity.
Correct.
So
Can
Luca,
I say sorry? Can I say, Steve,
course.
sorry? The one thing that is part of our role as promoters of ESG principle has been to say to explain to our counterparties the kind of data that they need to provide to us in order to be able to make us comply with the European regulation. Now, we have written to all the broker-dealer in the ILS sector and say some of this information, and as much as you can about the ESG aspect of the protection buyer or the sponsor, should actually be in the offering circular, right? Or in the easier for lazy investors in the investors presentation, right? And it may not come as natural for maybe a small or large US-based company to say, I need to provide data that the European Union is asking, right? But you know, and that's where we hope that when other prescriptive rules come up, you know, there will be some sort of harmonization, right? But you know, at this stage, it's not that if you don't provide exactly the piece of information we ask, we cannot invest. It may come out to that as these things evolve and get stricter. But the conversation has started and should be continued, you know, to the broker dealers and the brokers and the sponsors, and say, you know, you need to start thinking of gathering this data and making it available to investors, because we have an obligation to track it, and we have an obligation to report those who don't provide it to us.
And I suppose an equivalent level of data is already being made available through some other asset classes, through rating reports and ESG statements that come with certain assets. So it's important ILS is able to offer that as well. So that's good to hear. So Luca, finally, it's obviously ESG is a big topic in investor conversations right now. Is this something you expect to actually intensify, or do you think the industry will start to answer some of those questions for the investors?
Oh no, it will intensify for a number of reasons. You know, first of all, you know, Article 8 is a European legislation again, and you know, we are aware of a number of other parties working on something. So, you know, we're going to have the Swiss regulation. We're going to have, you know, asset manager associations regulation. You know, and you name it. So, the debate about what is relevant and what is not relevant is not going to be a short-term one, right? But so that's the negative. The positive is, if there is a debate, is already a massive starting point, because what we're all agreeing, you know, if we are starting to discuss on what you measure rather than why are you measuring it, you already made a big step forward, and you already are warning your counterparties that in order to maintain capital at the attractive level, capital, access to capital at an attractive level, you can't disregard this anymore.
And as those conversations continue, they are going to eventually filter down to companies that will need to make statements about their own climate readiness and ESG readiness, and I do believe that will result in opportunities for insurance and ultimately ILS as well, in terms of risk financing. Thank you both for your time today. That was a very interesting discussion. It's good to hear the progress on the ESG front, and that you're positive about the renewals going forward. So Luca, thank you for your time. Jillian, thank you as well.
Thank you, Steve.